Okay, well, those are some of the big headlines then at this hour. Well, today we're going to take forward our conversation that we kickstarted first last week on arbitrage funds. After seeing net outflows largely, especially during the second half of the last year, this year, so far, arbitrage funds have received cumulative net inflows worth more than 20,000 crore rupees. It looks like retail investors' savings have been increasing, spending once again has been decreasing. These may be some of the reasons. But why is it in particular arbitrage funds from all of the different categories of mutual funds? Well, we spoke about this topic with Mr. Harshvardhan Roongta as well last week, and he says that very often, the fact that these arbitrage funds provide a tax benefit is one of the reasons why a lot of investors choose them. They're categorized as equity funds for taxation purpose because the money is invested largely in equity assets. There's no market-linked volatility risk. The profit is the gains investor get for their period of his investment, and it is ideal for a lump sum investment, though of course sometimes individuals can opt for an SIP route as well. But the idea is that the fund usually buys a particular stock in the cash market and sells it in the future market. So it tries to take advantage of the mispricing that is often found in the markets for the same security. Now, this may sound a little complicated, but we'll try and simplify it. We'll take forward this conversation with Mr. Harsha Upadhyaya. He's the CIO for equity with Kotak Mutual Fund. Mr. Upadhyaya, thank you so much for joining us today on the show. It's a real pleasure. So to start with, Harsha, let's understand what is it that led to such heightened interest, investor interest, in this particular category of arbitrage funds, especially considering the fact that last year this largely saw outflows. What changed?
Good evening, Mobina. Yes, you are right. Compared to December 2020, in the last 4 to 5 months, we have seen fresh additions to the pool of arbitrage funds. This has been driven mainly because of the attractiveness of arbitrage funds vis-a-vis some of the other comparable funds that you may see. What it does essentially is to take zero risk on the markets. The way the arbitrage funds operate is, you know about cash market and the derivatives market. There are many stocks which are in the derivatives list as well. So there will be a long position on an underlying stock, and if there is a pricing difference, then equivalent amount of futures would be hedged. So it's completely neutral to the market. Market direction does not mean anything to the arbitrage fund. What it essentially gathers is the arbitrage difference that is taken at the time of the initiation of the trade. And upon expiry of derivatives, you get that arbitrage return in the fund. So it is very, very low risk product. And on the equity markets, it has no dependency apart from the fact that there has to be enough liquid arbitrage opportunities, but the direction of the market is not relevant. And also, as you rightly mentioned in your opening remarks, there is a taxation benefit that you get because this is classified as an equity fund. So given all these benefits, and which is also comes with high level of liquidity, people have generally tended towards this particular category to park their short-term funds.
So if you could just explain to our viewers as well, how exactly do arbitrage funds work? For example, you guys at Kotak Arbitrage Fund, what exactly is the investment strategy that you all deploy?
So out of the total corpus of the fund, anywhere between 65 to 90% is invested into equity and equity-related opportunities, which means let's assume that there is a stock ABC, which is available at 100 rupees. And let's assume that it is available in the derivatives market at 101. So there is a difference of 1 rupee between stock and futures here. So we actually go long on equity, and to the equivalent level, we go short using the futures. And the difference 1 rupee is what is known as arbitrage margin in this case. And that is available to the fund upon expiry of the derivative contract, because the equal and opposite positions that we have taken on the long side as well as on the short side get nullified at the end of expiry. So this is how the fund operates. So anywhere between 65 to 90% would be in arbitrage opportunities. We may hold it till the expiry, or we may churn that particular stock When we churn, we will churn the pair itself, the stock as well as the corresponding futures, and may get into another stock and corresponding futures of that particular stock if there is a higher arbitrage margin. This is how it works. And mandatorily, there is some portion of the fund which is required to be kept as margin money. That is where you will earn something equivalent to liquid funds in terms of returns. And the rest can go into arbitrage opportunities. So that's how the fund is operated.
You know, Harsha, actually, you've kind of given me a cue for my next question, and that is, the strategy that you are essentially taking advantage of a mispricing means you more or less know what your profit is going to be. So, in a way, is an arbitrage fund largely? Can we say that it gives you more confidence that yes, there is going to be a positive return, regardless of how the markets are moving from an arbitrage fund?
Yes, one could say that, but there will be certain points of time where returns on a point-to-point basis can become negative in a very, very short term, because the arbitrage margins could expand between the two expiries, etc. But largely for an investor who is staying put with the fund, there is absolutely no fear of negative return. And the position is also completely hedged, as I explained. The equivalent amount of stock and futures are taken as one single position, and simultaneously they are traded, whether during the entry or during the exit. So to that extent, the returns are not dependent on direction of the market. And that's where it gives us a somewhat stable and reasonably expected rate of returns over a period.
Okay. So, how would you compare an arbitrage fund, to a liquid fund, to a short duration fund? Because, like you mentioned, returns are stable, they are relatively reasonably predictable as well. So, how would you compare it to those categories?
Obviously, the investments that happen in each of these categories are very, very different. While arbitrage funds look at equity and equity-related securities, liquid funds invest in fixed income markets. Short duration funds also invest in fixed income markets. Here, I would say that the other benefit compared to liquid category or a short duration category is the fact that it comes under equity taxation. Since most of the arbitrage funds keep at least 65% invested in equity or equity-related securities, it is counted as equity fund from taxation perspective. So if you are holding it for any period more than 12 months, it is termed as long-term, and hence you come under the long-term capital gains taxation. So to that extent, this is going to be beneficial as compared to the fixed income. The tenor of holding can be lower, and still you can come under long-term taxation if you hold it for beyond 12 months.
All right. Harsha, let's understand then in terms of in which market environments or interest rate environment is an arbitrage fund most poised to deliver good returns?
To determine the ultimate return of arbitrage funds on an ongoing basis. For example, there is a link between what the short-term interest rates are in the economy, because one who is carrying that long position is expected to get a certain level of interest for that. And that is usually more or less in line with the short-term rate. One can expect very different rates than what is there in the short-term in that economy in terms of interest rates. Second is the fact how much of investor interest is there in equity markets in terms of taking long positions. So usually in bullish conditions, people are okay to pay slightly higher arbitrage margin, as in they pay a slightly higher premium on the futures to carry the position for a month or beyond that. So to that extent, in bullish conditions, expectations of stocks giving higher returns are more, and hence there is more interest in terms of carrying forward those long positions, which is what is used for arbitrage positions, because in arbitrage funds you take exactly opposite positions. So that is something that will determine the overall returns. And also the fact that what is the hedging cost for non-rupee investors to hedge their position in rupee terms. Because if the hedging cost is more, that means their cost of capital is more, and they would try to look at a certain level of minimum returns. So they will not really put pressure on the arbitrage margins, because in this market, we also compete with money that comes from foreign markets, which is obviously at a lower interest rate. So for them, the cost of money is lower than for Indian investors. Nevertheless, they need to take a hedge on the currency, which is Indian rupee. So ultimately, if that cost is moving up, then that means the arbitrage margins in the domestic market can also move up, because a section of investors will find it hard to really build their positions at lower arbitrage margins. So these are some of the things, and a combination of these factors at any point of time would be driving overall arbitrage returns.
So in the entire hybrid, fund category, or maybe even equity category, would you say that an arbitrage fund carries relatively the lowest risk?
I would say almost equivalent to zero risk. If at all there is a minimum risk, I'm saying that only because there are unhedged debt investments in that portfolio. But the entire equity position is completely hedged with equity derivatives. So there is absolutely no dependency on the equity markets for the returns in terms of direction of the equity market, especially. So whatever little risk would be there because of the fixed income investments that the fund is mandated to do as margins. But practically, that is also can be counted as very zero or close to zero risk in terms of negative returns.
Okay, great. So in many ways, it could be comparable to fixed deposit returns as well. In terms of suitability then, Harsha, what financial goals you think an arbitrage fund would help a retail investor achieve?
See, as you rightly said, this is comparable to fixed deposits and liquid fund investments, though arbitrage funds are superior from a taxation perspective. So on a post-tax basis, at least historically, they have given better returns and are expected to remain that way going forward. So anybody who is looking to park surplus funds in the short term can use this particular route to really deploy that, and it is more tax efficient and can provide highly competitive post-tax returns. And the liquidity is available on an ongoing basis, so there is no lock-in like that you would see on a fixed deposit. So more liquid and offers better post-tax returns. So one could look at parking short-term funds wherever there is a surplus, or if you have a financial need coming up at some point of time in the future and you don't want to get logged into any other asset class or any other fund, this is a fund which will give you predictable set of returns for that short term. So one could use that.
All right. Okay, well, there you have it. And I hope and I'm sure that this essentially, does give our viewers a good insight into how things function in arbitrage. Yes, there are some jargons, especially with respect to the futures markets, etc., that viewers may not understand. But yeah, in terms of the riskiness in terms of zero return or negative return, that's extremely low. It's close to zero, in fact, the risk for those perspectives. But otherwise, it's a great product. It's comparable to fixed deposits, only that it is better because, you have the tax benefit as well that comes around with an arbitrage fund. In a fixed deposit, you could be subject to taxation as high as 30% because it depends on your income bracket. Over here, of course, it's looked as an equity investment as well, the arbitrage fund, and it does find a wide variety of users as well in your portfolio. Harsha, just a last question then. Of course, Kotak has one of the largest arbitrage funds. I think the AUM is almost just a little short of 20,000 crore rupees. What's your investment strategy, the investment funda that you use when you operate the Kotak arbitrage fund then?
So on the arbitrage side, we take completely hedged positions. There is never any open position. As per the investment mandate, at least 65% of our investments at all points of time will be in this category, which is your equity and derivatives completely hedged positions. We also take some fixed income investments which are mandatory to take derivative positions. Again, those are earmarked as margin money, and they will keep earning a certain fixed level of interest for the fund. And if there is anything else that is remaining in the fund, and then we could also invest in some short-term liquid investments on the fixed income side, just to enhance returns depending on the investment opportunity. Even if we have investments on the fixed income side, we are very, very cautious in terms of both credit as well as duration. We are going to be looking at the highest credit levels for the investments here, and also the duration is going to be very, very short. So in effect, the risks that are there in terms of equity market volatility or credit risk or duration risk when it pertains to fixed income part of the portfolio, those are all close to zero or almost zero in some cases. So I would say that while it has a combination of equity and fixed income investments, we also invest into derivatives, which many of the diversified funds may not do. But there is absolutely no risk in terms of the direction of the equity market and its impact on the portfolio and returns. And similarly, the fixed income investments that we make are also of very, very high quality and very, very low duration. So all in all, this is one of the safest products that a retail investor could look at, especially to park short-term money and also get reasonable returns with better taxation benefits.
All right. Okay, well, Harsha, we leave it at that. Thanks so much for joining us today on the show and simplifying arbitrage funds for our viewers. We'll, of course, be putting up this interview on YouTube as well. So it's a ready reckoner for any time investors and viewers do want to catch hold of this conversation again.